Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, and this is the session where we'll be talking about the Q4 earnings. The company on our radar right now is staffing company TeamLease Services, which has reported an almost 23% decline in the consolidated net profit at 24.37 crores. The revenue from operations for the company, however, have seen a growth of 11.5% during the quarter under review to 2,027 crore rupees. Now, to understand more about the insights from this quarterly earnings and the outlook going forward, joining in is the top management of the company. With me, Ms. Ramani Dathi joins in. She's the CFO at TeamLease Services. Welcome, Ramani, and thank you so much for taking the time out and taking the questions from us. Well, how have the Q4 earnings really panned out? Are they as per your expectations? Help our viewers understand what worked and what didn't work for you in the March quarter.
Sure, Sakshi. So Q4 has been a mixed bag for us because general staffing business, which is our main business, has done phenomenally well. We have added 8,000 additional headcount in this quarter. However, that has been entirely wiped out by the headcount loss we have in our degree apprenticeship business as well as the IT staffing business, because both the businesses are having headwinds, either on macro side or on regulatory front. So, in the month of January 2023, government has withdrawn the scheme on NEEM, which is the apprenticeship program under which we have roughly about 45,000 trainees. So that headcount we have been losing. So that's a higher margin business for us. So that has impacted the margins as well as the drop in revenue.
Okay.
And as far as IT staffing, the specialized staffing vertical is concerned, for the last 2 quarters, we have been seeing the trend where the hirings are on freeze on IT side, and even the numbers have started slightly coming down. So given these two segments, whatever headwinds, industry headwinds that these segments are facing, so that have impacted our revenue as well as margin. But the main business, general staffing, it is on track, and we have posted 23% growth in that segment on a full year basis. And the outlook for general staffing is also looking quite positive.
Right. So I will come to the outlook itself for the current quarter, that's Q1, and for the full year of FY24. What is your own sense of how is the business looking like?
Again, so general staffing is looking very good. So we are consistently adding headcount month on month. On average, about 3,000 new employees are getting added every month. And this is across segments. So we don't have concentration with any few sectors or any few clients. So we are seeing uniform growth, while BFSI has been the largest contributor for us over quarters.
Okay.
So we are getting growth from other sectors as well. And as of now, manufacturing, we haven't started getting a large number of headcount, but based on the discussions we are having with our clients, we are very positive in terms of the future growth that we can expect from manufacturing segment as well.
Right. This time around, we did see the margins also have softened for you. Is there a dip across segments in the margins? And do you believe the pressure is likely to continue? And if yes, then due to which reasons and for how long will the margins be under pressure?
So the margin pressure, as I mentioned, is mainly on account of the IT staffing business and the apprenticeship business, both of them going down. And these two businesses are higher margin business. So just to give you some background, our general staffing business is a 2% margin business. In fact, at a net level, it is 1.5%, whereas IT staffing is an 8% margin and degree apprenticeship is a 5% margin. So since these higher margin businesses are having these headwinds and losing numbers, so that had an impact on our overall margin. And we believe for next 2 quarters as well, this margin pressure will continue. And from Q3 of next year onwards, we can expect at least a 20 basis points improvement on margins on a sequential basis.
Q3 of FY24?
Yes, yes.
Okay. Okay. On the IT staffing business, which you're saying that there has been some dip as far as the margins are concerned, also, hiring freeze, those are the pressures that you've been facing as well. Could you talk to us about the trend here? What is the outlook, both going forward from here in the current quarter and the full year as well? How will the tech-linked job market really pan out?
So we have opened this year with, very positive outlook. First quarter, we have added very good headcount, and even the previous 2 years on IT front has been phenomenal for us. So we had almost 35% growth in terms of both top line as well as bottom line. And surprisingly, all of a sudden in Q2, everything has went upside down. We started losing numbers, and it's not just specific to TeamLease for sure. So this is the global phenomena that we have started seeing. And while we have expected some sort of green shoots in Q4, because we thought maybe from Jan, once the new budgets open, so companies may start hiring, the IT companies may start hiring. So we expected some positivity in Q4, and unfortunately, it didn't happen. And basis the ongoing trends, it looks like at least 2 more quarters, there may not be any major hirings in the IT segment across all the tech professionals. So that's why we are saying maybe from Q3 onwards, we can expect some kind of momentum. And this is mainly we are saying at mid and senior level. The entry
Okay.
level hiring to some extent is still happening, though it has slowed down, it is still happening. And some replacement hiring is happening. But the mid and senior level overall hirings are completely on hold across all IT companies.
Okay, understood that. I also wanted to get a larger sense from you beyond the earnings as well, since we are talking about the IT staffing business. The larger talk over the last 1.5 months has been about how AI is going to take away some jobs. What have you really assessed of the situation so far? Because we have got mixed reviews, mixed comments coming in from most of the major IT companies. There are IT companies like IBM, which are saying that we are going to clearly see some losses taking place because of artificial intelligence. Others like a TCS, HCL Technologies, or Infosys have been saying that we've been seeing artificial intelligence over many years right now, and it's a different set of skill set and everything, so it will not really impact that much. But what is your own sense of how are you looking at the industry shaping up and taking to this adoption of newer technologies?
Yeah. No, definitely those companies are the experts. They being in this business, they know it well. But I mean, my sense is that it may create new jobs. It's not like taking away jobs. So some jobs will come down. Some of the existing jobs will come down. And it will definitely create new jobs. And we have seen this kind of negativity in the past as well, when there were newer trends and newer technologies that have emerged. So we don't think overall jobs will go down. It may go down in one segment and go up in another segment. So that's our sense.
Okay, understood that. And for FY24, if you could share with us what is your own target when it comes to margins and the revenue outlook as well?
Yeah. As far as revenue is concerned, for us, the long-term CAGR target is always 20 to 25% top-line growth. And even for FY24, we are confident of achieving that number. And in terms of margins, as I mentioned, Q1 and Q2, there may not be any kind of margin expansion because of the reasons that I mentioned. Also, in Q1, we'll be having our employee appraisal impact, the annual hikes and all that we give to our core employees.
Yes.
So definitely in Q1 and Q2, there won't be any sort of margin expansion. But from Q3 onwards, at least 20 basis points expansion is what we are targeting.
Okay, and what would that take your number to? Currently, it is around 2%, you said?
So again, it's very difficult, Sakshi, because our margins are computed on the gross revenue, which includes the salaries of the employees, almost the 2.5 lakh employees that we have on our payrolls. And these salaries are determined by our clients, not by us. So if we hire more employees in cities and higher salary profiles, so that will lead to a different margin for us. So we don't want to comment on the margin number per se. We don't want to give any guidance on that. But the target is at least a 20 basis point improvement on whatever we close by end of Q2.
Okay, understood that. Since you said that, this time around the general staffing business has done very well for you, also wanted to get a sense of has the performance been, similar across the sectors for general staffing? Have there been some variations there, some performing better than the others?
For the last few quarters, banking and financial services has been giving us a higher numbers, and this trend may continue for a few more quarters as well. And also the other sectors, engineering and pharma, and all the other service verticals, we are seeing good momentum now. The earlier we used to get a lot of numbers from the startup ecosystem as well, fintech companies, edtech companies. So those numbers have come down. Fortunately or unfortunately, our exposure to startups is very limited. It's only 2% exposure that we have. So we didn't face any major impact because of that. But definitely that vertical has seen a very sharp decline compared to last year, the hiring trends that we had in last year.
Yes, in fact, the layoffs have also taken very, very sharply in the
Yeah.
startup world itself. What is the outlook there? Is it likely to improve soon enough, or is there going to be some more time away?
At least for next 2 quarters, we are not seeing any kind of new openings that are coming up.
Mm-hmm.
So maybe after a couple of quarters, whether it picks up or not, we have to see.
And what would be the key factors on which it will depend? Is it going to be largely on how the global economies really take shape, or what are the other things that you think that these companies will become more positive on hiring more then?
I think more importantly, it's the pressure that they are facing on their cash flows and
Yeah.
profitability, because almost all of the startups are running on huge losses. And I mean, their cash inflow from investors have stopped, and many corrections have happened to their valuations. So some of these
Yes.
startups may not go for immediate fundraise at this corrected valuation numbers. So they
Mm-hmm.
have to focus on their cost optimization, and for that, first, they have to optimize the existing employee base that they have, keep a hold, keep a complete freeze on new hirings. So that's what is happening. So till the time there is a recovery in their valuations and the PE money coming into the startups, we don't expect any major hiring trends to pick up there.
Got that. Well, thank you so much, Ramani, for being with us on the show and discussing with us all these very important insights that are very valuable for all our viewers to really understand how the industry is also shaping up as well. And here's wishing you all the very best for the upcoming quarters, hoping to touch base again to get more understanding about the business insight and the outlook going forward. All the very best. Thank you so much.
Thank you, Sakshi.
All right, and with that, we will wrap up this edition. TeamLease Services mixed quarter this time around. There have been some pressures, but 2 more quarters is when there could be slight pressure coming in as far as the IT staffing business is concerned. That is likely to see some more pressure coming in because the hiring trends do not show quite encouragement or encouraging trends at this point in time. 2 more quarters before things really shape up for the better. We'll keep an eye out on all of this, so you stay tuned with us on Business Today TV to catch all the updates from the world of business and stock markets. Until then, thanks for tuning in.
If you like the video, do like, comment, share and subscribe.